Welcome to Wealthy Experts, where we interview experts in their field so we can learn all the best ways, tools, and tips that they use to build a wealthy life. I hope you enjoy the episode. Welcome, everybody, to another Wealthy podcast. And today we're very lucky to have Paul Miron from MSquared. He is one of the co-founders and managing directors over there. Paul, thank you for joining the show today.
Thank you, Domenic. How are you?
Very, very good. There's a lot of interesting news. For all of you out there, Paul actually does a monthly subscription where you can log on MSquared, and he does a detailed review and analysis on the market. He's a very well-read and versed man in real estate, in finance, in economics. He's someone that I occasionally like to catch up and just, at least a couple of times a year, like to sit down and sort of pick his brain and see what's going on in the markets. He is televised. You probably see his face. He's familiar on TV as well. He's catching up with all the major economists. So great to have him on the show today. Paul, you and I were sort of gibbering on earlier about a few different things. So there's a lot to talk about today. There's migration, there's COVID, there's the state of the interest rates, state of finance, what's happening in investments. Well, where do we start? Yeah.
Absolutely. Well, I think right now it's very topical in relation to having that bit of a crystal ball effect and seeing what's going to happen with the property market next 2-3 years. Because we've had multiple articles written by different economists saying we think the market's going to go up 5, down by 20, or down 20, and maybe not up by 5. And look, even from a political perspective, property prices is becoming a very interesting topic because you got this situation of affordability. Properties are less affordable now than they have been for decades. So where from here when we have zero interest rates as well. So it's becoming a much more bigger conversation piece. I think Australians are in love with property. If you go to a barbecue, everyone's talking about property, and the house next door that sold for $1 million what they were expecting, and for a small nation like us, we have more than 60% of our wealth in property. Per capita, we are one of the wealthiest people on the planet. So if you put all that together, where property prices will go in the future, or our expectation, has a significant impact in relation to our economics and how we have our family budget and households. So yeah, it is a big subject right now, isn't it?
Yeah, it is. And I mean, for you specifically, so let's just for everybody out there, can you just give us a quick pitch on what MSquared does, MSquared Capital, because it'll create a lot of relevance for this conversation. I know you guys, but I'd love for the audience to know you too.
Sure. So MSquared Capital is essentially deemed as a non-bank. What we do for investors, we allow investors to create their own platform. We have a platform and we allow them to create their own diversified portfolio of direct mortgages. So what we do is we have what's called a contributory fund. When I try to explain it from a technical perspective, people still scratch their head and don't understand exactly what it is. The best way to explain it is, Domenic, a lot of people like to have their own property, direct property. People like to buy their own direct shares, for example. So what is the benefit of actually owning direct property and direct shares? You have more control, you have transparency, you can control your own risk, and hopefully you'll be able to have a higher return than having all of those assets in a pool of assets with other people as well. So the same thing with mortgages. Investors are able to choose the specific mortgage opportunity. So for example, last week, we just settled a service station transaction. It was tenanted by Woolworths, 10-year lease, strong tenant. It was a 2-year facility, 65% gearing. So we didn't lend more than 65% of the valuation. And we were returning 6.75% net return to our investors. So investors were able to choose that as part of their portfolio as an investment. And today we just launched another one. For example, a property, a borrower needs to borrow 75%. For our investors, we did a 65% gearing, 6.75 net return, and it's an apartment in Manly. It's in a promenade looking over the water. So those are the type of opportunities we give to our investors. They can choose, they get the due diligence, they're able to give us a call. We co-invest with our investors as well. So we're very hands-on. We have a lot of our wealth in the fund ourselves personally, between myself and my partner, Paul Miliotis. And we manage the debt facilities the way that we manage our own money. So
right.
we've been doing this for a long time. So,
so in a nutshell, it's non-bank lending, and you go out there, give the money out to different real estate assets. It could be commercial, industrial, or residential.
that's right.
People, investors come to you, they go and get a 5, 6, 7% cash on cash return, paid in arrears. And it's just a way for them to diversify their portfolio when they're at that stage where they're really looking for cash. So the reason why I brought that up is because all of our investors out there, it's good to get a bit of perspective on how you're thinking about real estate and how you're thinking about wealth management in perspective with how you operate your business. Now, what's the one thing that you're currently sort of paying attention to in the market that you think is going to have a massive impact in the next sort of 12 to 24 months or even 36 months? Like you've got to weigh up risk, you've got to assess debt, and you've got to assess, the market outlook. And a lot of your facilities are 9, 12, 24, 36 months. So what's the couple of things that you're thinking about or keeping your eyes on?
Well, if you look at risk, you have to disassemble risk in two aspects. One risk is what we can control. And what I can control is our internal assessment of a particular transaction. So what is the gearing? What's the security? The type of security we can do? What's the gearing that we will do on a particular security? How liquid do we think the security will be in a difficult market? Who's the borrower? Do I know the borrower? Do we do the checks on the borrower? Is he a person of character? You look at that particular borrower needs to have competency. He needs to have good cash flow, because at the end of the day, our investors don't share the upside in the asset that they invested. It's a fixed income in the respect that they need to have the regular income. They want to make sure the borrower is able to afford it. So those are the things that we can control. And that's the things that we share with our investors. The things that you can't control is a macroeconomic. And that's where it gets a little bit interesting. So we have a view of the macroeconomic. Obviously, when everyone's talking about property at the moment, everyone's concerned about what's happening with inflation.
Yep.
So let's talk about inflation, because it will have a significant impact on all asset prices. So whether it's property, whether it's the share market and other asset classes, inflation has a significant impact. Now, there are two schools of thought right now in relation to inflation. During COVID, when we were in lockdown, we were sitting home, we were, watching Netflix, and essentially buying our groceries from the internet. Our lifestyles were very different. So when you look at data from when you were sitting from home to now, when we're out of lockdown, a lot of inflation markers are a lot higher than what normally would be. So for example, petrol, if you're not using your car, and obviously petrol is a little bit higher now than it was before the lockdown, because there are restrictions on trade and things such as that, but supply chain issues, but everything is amplified. All that data is quite skewed. So there's two types of economists right now arguing two things. That inflation is either permanent or is it transitionary? So if it's transitionary, it's basically 6 months, in 6 months' time from now, inflation should come back to its parameters. Now, the reason why it's so important is that all the reserve banks around the world, they need to keep inflation under 3% or close to. If they allow inflation to go too high, you're going to have a reverse situation where prices go out of control and people can't trade normally with confidence. So it's not an ideal situation. So this is the biggest question mark right now, is what's going to happen with inflation. Now, if interest rates do go up by 1%, if you look at the analysis done even by RBA, Peter Tulip did a really great paper in relation to what actually drives property prices. And interest rates is one of the biggest drivers. So an average household, for example, 35 to 40% of the after-tax dollars of an average household spends the money on a mortgage. So if you have 1% increase in mortgage rates, it's a 15% increase in their repayments. So they have less money to spend. They can't afford the same property that they would have bought before that interest rate increase. So it's a trickle effect. So that is the number one question mark that sits over the property market and the economy right now, is what's going to happen with inflation.
And do you have any sights on that, or any? Do you believe that we are facing any potential risk with inflation, hyperinflation, stagflation? Do you see that things are okay, or?
Well, look, my personal belief is that what's underestimated is the transitionary period, meaning that when you're in a lockdown and you're coming out of lockdown as well. I do believe that if businesses are quite efficient, if there's a larger demand, they'll find the capacity to suit that demand. I think the risks that we have is labor in Australia. A lot of people haven't really spoken about, but a lot of temporary visa holders, there are about 340,000 jobs that were lost the day that we went into lockdown, because all of the students or temporary visa holders went back overseas. So that has a significant impact. And so that's why I wrote an article recently about immigration, saying, well, look, once the borders open, having a high immigration will keep the wage growth to a certain level. Like in the US, for example, right now, they're saying that wage growth is closer to 6 to 9%. I think Australia, if we were to have wage growth of 6 to 9%, then that would actually push through to our inflation figures and keep interest rates to go up. The worst thing that you can have right now for our recovery is that you've got restaurant owners can't even hire people to even service the restaurant. They can only open 2-3 days a week because they don't have any labor. Yeah. It's a very unfortunate situation. They got hit with 2 years worth of COVID, and now they can't even hire anyone because there's no labor market for that. People who could have got another job. So there's no one to have to replace that particular profession. So I think I see risks in relation to it, but I also see certain things that the government will do to be able to cushion that risk as well.
Yeah, it's interesting because I read your, and that's the reason why I brought up your monthly newsletter. I read your monthly newsletter on inflation. I found it very interesting. We have similar points of view on this, where I do believe that once the borders open up, I mean, it's supposed to be opening up tomorrow, maybe not, 1st of December, depending on when we release this podcast. But it looks like there are going to be more and more people coming in. And it seems like there's a similar sentiment into the political system, where they do want to open borders, they do want to encourage migration, and they do want to encourage students. So as you've said, there's hundreds of thousands of people, 200,000, 300,000, 400,000 people that should be coming into this country and will be shortly, that will fill up that labor shortage, both in trades, hairdressers, the picking fruits, all sorts of stuff. There's things that we don't think about that need people there to fill those jobs.
Well, look, as a business owner, we've felt the same thing, is that there is a shortage of, for example, cadets that you can get to work in your business. Everyone's fighting over the same students that are already here. So look, I think a lot of people don't realize that education contributes about $40 billion to our GDP. It's our third largest export item before COVID hit. So, I'm sure the government is very willing to open up borders for many reasons, because it also cushions our economy for future sort of black swan events as well. Like for example, Canada is looking at actually increasing its migration. It's proposing to have 2.6% net migration to their population. That's significant. Even before COVID, Australia was second in the world with 1.6. So just the mathematics in relation to, if you increase your net migration by 1%, it actually increases your GDP by 2%.
Wow.
So, if you really want to start working out the value of migrants, you just need to look at a couple of core statistics. But there's also a counter argument as well, is to say, well, you can increase your aggregate GDP by getting migrants, but at the same time, are you increasing quality of life? And that particular measure is done per capita. So how much income is generated per person? And in that particular measure, Australia sits 13th in the world. So, it's a really delicate thing in relation to bringing the right combination of migrants. For example, do you only bring skilled migrants in, or how do you loosen up student visas? one of my arguments is that we have probably a lot of shortage in short-term sort of employment sectors like hospitality, fruit picking. And so that's an opportunity to loosen up the student visas, because on that particular visa class, they can only work 20 hours a week. So, you might create a different visa class where allowing them to work 40 hours a week and do part-time study as well. So those are the things that I'm sure the government is now exploring, just to open it up a little bit, because there are gaps in our labor market that can be filled very, very quickly. Whereas countries like America and Europe, they're struggling because they're unable to fill it. And without being able to fill those labor issues, you are not creating efficiency in your market, and you are creating inflationary pressure as well.
So it sounds like to you that opening up the borders, allowing migrants into the country is going to solve quite a lot of things. I mean, we do need to be mindful of quality of life, but fortunately, we have had a government that's been very aggressive on building infrastructure across Australia. So that is to support a growing population. Now, another thing that we've been talking about recently, now that's certainly a demand driver for real estate to push prices. We spoke about interest rates potentially going up. That's going to be pushing, that'll take some of the steam out of the market. But one thing that we haven't discussed, but we should, is your thoughts on supply.
Yeah, absolutely.
Now, supply is an interesting topic, because I felt like, being on the front line, COVID hit, many developers basically stopped a lot of their projects or slowed a lot of their projects. There was a massive lack of supply onto the market. And there was also a massive issue where people just stopped selling real estate. It wasn't an issue, it made sense. That's why we saw this huge increase in prices. Have you seen any interesting statistics or data talking about supply and what that's going to look like over the next, near term?
Look, interesting that you say. Funny enough, we're talking about property prices in the future. Okay?
Yes.
We're talking about interest rates. The other really interesting aspect in relation to property prices is very simple: is demand and supply. And let's talk about demand and supply in two different characteristics. You've got demand and supply on what's listed on the market at the moment for anyone to buy a property. Okay, so during COVID, during the last 2 years, you had a very low amount of availability of people wishing to sell a property. Now that we've come out of lockdown, we've had a surge of listings. It's actually higher now than it has been for the last 4 or 5 years. There was a 30% increase in listings just in the last 2-3 months. And so when you're looking at the clearance rates, you can see the clearance rates have actually started falling a little bit, only because you've had a lot more willing buyers than you had supply, and that particular time in the market. Okay, so now what we're seeing is that the heat of the market coming off a little bit, because people have an option. For example, if I've been looking for a house in a particular area, 500 square meters, there would only be 2-3 houses in that area available in a year. Now there's probably 10, 15 in 1 month. And so therefore now you're seeing that heat of the market come off a little bit. So that's one aspect. Another interesting analysis as well is that systemically, we have an undersupply of housing in Australia. Okay, so that's actually cushioned. It actually cushions when we have a bit of a issue in the economy as well. So some interesting stats there is that with the current migration pre-COVID of 160,000 a year, we need about 40,000 new dwellings. So in the last decade, we've only had 1 year that we've actually supplied more than we needed for the yearly amount. So every year that we go along, we're actually supplying less than what we require with the current migration policy, which is close to 160 to 180 migrants a year. So that's 40,000 New South Wales, by the way.
Yes.
But another interesting piece of information is, because we got so much undersupply, Peter Tulip did another interesting paper for the Reserve Bank 2-3 years ago, is that the average person in Sydney is paying 73% more for their house because there's not enough supply in Sydney. So that's about $489,000 off the medium. In Melbourne, it's about 324,000. In Queensland, it's lower because they've been able to deliver more land and their planning system is a lot more efficient. So when you actually look at the Eastern Seaboard, why is Sydney most expensive? It could be for the fact that we have chronic undersupply, one. Two, our planning system is very slow.
It sucks.
So by the time you want to put a DA in and get it approved and deliver it, you may have already missed the whole property cycle.
Yes.
And that developer might have to wait on that DA until the next cycle. So we're not as nimble as we are in Queensland, for example, with their planning process. So you can actually relate back, this paper was fascinating. It's actually related back what the costing is to each apartment and each house on the lack of supply that we have in Sydney, Melbourne, and Queensland.
And it's something that's felt when you're buying real estate. You can see, you can feel it and understand it. Supply and demand is one of those things that as a real estate investor, you understand it, particularly if you get your hands and feet, dirty. You go to an open home and if there's 5 people there, you feel this fear of missing out.
Yeah.
You feel like there's competition. If there's nobody there, then suddenly you feel like you've got a chance. Now, if there's a lot of supply coming to the market, there's a lot of opportunities, the same 100 buyers spread out across all the different houses, estates, and development opportunities.
And it keeps the prices lower. So it's just a very simple demand supply. It's a first chapter on each, if you go to university and you start economics, it's the first lesson that you get taught. The simple demand supply equation, the more of something, the cheaper it is. The less of something, the more expensive it is. It's just very simple.
Yes. And thank you for that breakdown. We look forward to your next paper. That's coming out surely the end of the month. So you must be driving your family mad.
Yeah, I am. You've been speaking to my wife then. Yeah, I walk around the house trying to think what I'm going to write next. It's always a bit of a challenge. But yes, end of this week, I'll be writing a new article.
Well, Paul, I know that you're a busy man. You've got a buzzing office. I don't want to take up too much of your time. Have you got any parting thoughts for our listeners, viewers, all of our greatest guests out there?
Look, I think the other interesting thing is there's a lot of talk about negativity in relation to maybe we're at 12 o'clock in the property cycle. But after 25 years experience being in the industry, there's opportunities all the time everywhere. It just depends on how hard you're looking and making sure that you actually are always stayed in the market, you're always diversified, and you're always able to absorb the information and get good advice from people as well. So despite the fact that we can see risks with inflation and there's a shortage and there might be other elements in the economy that you can't control, but what you can control is being able to be active all the time and there's always opportunities to make money, whether it's buying direct property, whether it's investing into a mortgage fund such as ourselves, and there's other opportunities out there as well. So that's my imparting advice to listeners, that do not get too carried away with the negativity in the news all the time.
Yeah, always be active, have your eyes and ears open,
And
thank you all for your attention. And this is good advice. There's different ways for you to go and get a solid return. You don't have to leave it in your bank and earn, what do you get at a bank now? 0.5%?
0.1% if you like. Well, that's official cash rates, but yes, you're close to nothing.
Yeah.
There's plenty of opportunities to make money all the time.
Thanks, Paul.
No problem.
We really appreciate your time. Thank you again. For all of you out there, if you got value today, love to hear what you liked, what you didn't like. Leave it in the comments. Like, subscribe, all that fun stuff. Share it with all your friends, and we'll see you on the next podcast episode. Catch you later.
Thank you.